Welcome back. Y'all wanted more. Y'all wanted more. You joined the live yesterday and y'all asked some questions that told me you wanted more. And so we're giving you more. This was supposed to be the finale. But guess what? We're adding a fourth session next week, Monday, 5 o'clock. We're giving you more. Okay. We're going to be talking about leveraging debt like the wealthy do. But tonight we're laying the foundation. Credit fundamentals, building blocks, the tools, the secrets, the stuff that absolutely nobody teaches you in school. Yes, we're going there. Everybody wants an 800 credit score. But half the people chasing it don't even know what they do with it when they get it. Okay? If checking your score feels like a pop quiz that you didn't study for, this session tonight, this one's for you. Because real credit confidence isn't about perfection. It's about positioning. When you understand your credit, you stop reacting and start strategizing. So grab your notebooks, grab your pens, and tag a friend. Because my community, we're not selfish, okay? Double tap that screen to let me know that you're here and you're proud of yourself. Give yourself a round of applause on my screen, right? And tell me where you're watching from tonight. What state are you in tonight? Double tap the screen and tell me what state you're listening from, okay? Because we're about to make credit make sense. Somebody put credit in the comments. If you want your credit to make sense, put credit in the comments. If you want your credit to make sense, to start making sense, put credit in the comments. Okay? Put credit in the comments if you want your credit to start making sense, okay? Credit. All right, now, y'all already know. I told y'all that yesterday. I told you this on Monday. I don't just be bringing anybody here, okay? I bring experts to the conversation, okay? I bring the best to y'all because I want y'all to learn from the best, okay? And so I bring the heavy hitters, and I'm bringing, again, tonight, Coach Talisha. She checks every single box, okay? She is a board-certified credit repair pro. She is Forbes, yes, that Forbes, culture honoree, CEO of Luxury Legacy Consulting and High Class Hustle Academy. And she has trained the trainers. Your favorite credit repair pro was probably trained by her, okay? She has helped over 500 families become homeowners. And what I love about this girl is she has a huge heart for y'all. The way she stays up all night thinking about how to make things easier, how to help move the needle for y'all. I'm telling you, some people just in this business for a check, okay? She is in it for y'all. So, without further ado, I'm going to bring Coach T back to the stage. Welcome back, Coach T.
Hey, y'all.
Thank you so much for coming in and giving us an extra bonus day.
Yes, I'm excited. Y'all ready? I'm ready.
I'm excited. Y'all, the plan was we was going to put what we're going to talk about tonight and what we're going to talk about tomorrow. We was going to do our best to cram it into this 1 hour, but it would not have done you justice. And we wanted you to have the foundational skills, and it takes some time to learn all of that. And we wanted to have a full conversation about leveraging credit, that final step, and credit responsibility, and just feeling like having unfuckwittable credit, right? That needs its own conversation. So we're going to table that for Monday. All right. So again, welcome to the conversation. Thank y'all for coming in. I see we got Brenza Wimberly back. Welcome, hey. Brenza. Thanks for coming back.
That's my mama right there. Hey,
how you doing, mama? I love it. Y'all could be anywhere tonight, but y'all clocked out of y'all that other man's dream, your job, your 9 to 5, and at 5 o'clock you clock back into yours, and I'm proud of you. I'm proud of you because you could be watching Ratchet TikTok right now. You could be watching Ratchet television right now. You could be, but you're not, and we appreciate you for coming on in here tonight. Okay, I see big things for your financial future because you're investing in your own development right now. Give yourself a round of applause when you do though. Do it on my screen. Double tap. Okay. So I want to go ahead and just jump on in this because we have a lot of questions to cover tonight. Is that okay with you?
Let's do it.
All right. So here's my thing. I get this question a lot. I want to start with Credit Karma. Okay. We had Billy Lewis ask this question yesterday.
Okay.
Yes, relation. You know how they be like, no relation. Yes, relation. Billy Lewis asked this question yesterday, so I promise I will make sure I will ask this question today. And that reminds me, audience, if you got questions, put them in the chat now so we can make sure we can try to get to y'all tonight. But he asked this question yesterday about Credit Karma and whether or not you should sue it. Because I know everybody kind of used it or tried to use it before. Mm-hmm. And so when people ask me this question, here's my thing about it is I tell people it's fine as a clue that something has changed. It depends on how you're using it, right? Mm-hmm. If it's to get a clue that something's going on, absolutely. It gives you a trigger, the score change, something reported, it gives you a clue. But it's not your real score. Okay.
Right.
So can you explain the difference between the Vantage score, which is what Credit Karma uses, and the FICO score, which is what most lenders use for the audience?
So honestly, exactly what you said, right? It's good for your report. Don't focus on Credit Karma for the score, because what happens is you focus on the score and you're going to stress yourself out because it updates once a week. Normal credit monitoring, paid credit monitoring, it's once a month. So Credit Karma, I say use it when you want some updates that are a little more real time, but don't focus on the number. This lets you know what accounts to work on. Everything else, I wouldn't use it for. Think of it, it's a free tool, right? So everything may not benefit you, but some things will.
Okay. So I was thinking to myself exactly like why one area might be your Credit Karma score might be 40 points different from your FICO score. Mm-hmm. Can you explain the difference between the Vantage score and the FICO score and why they differ so much?
Yeah, absolutely. So when you think about the FICO score, that's your Fair Isaac Corporation. Okay. So Fair Isaac Corporation is what FICO stands for. That's something that calculates your lending rate. I think that's the easiest way to put it. So it tells lenders, it's your report card. It tells lenders how likely are you to repay whatever capital they provide to you. Okay, whatever that is, because when you're applying for anything, you're applying for capital for whatever major purchase you're making. When you think about the Vantage score, I like to consider it your shopper score, right? So that's something that mostly you would look at, not a lender, someone who's lending you credit. So that gives you the ability to see what's on your score, and it calculates it based upon the 5 components of the credit score. One of the examples I'll give you is like your inquiries, right? FICO recognizes any inquiry in a 13-day time span to be one inquiry because it understands that you have to rate shop for the best rate, whether it's your student loans, your mortgage, your car payment. So all of those inquiries will be recognized as one. But on your Vantage score, because it's calculating it based on the 5 components of the credit score, it's going to add and subtract your score based upon just those numbers. It doesn't factor in your buying power.
That's good. Can you talk about like the range in scores? Because the FICO score and the Vantage scores have 2 totally different ranges. So sometimes people are like, my such and such, they got a 900 credit score. And then they're hearing that you can't go above an 850. Can you help them understand the difference between those score ranges?
So when you're thinking about FICO and your regular rate shopping, they're all going to range from 300 to 850. Where they begin to differ and you see 900s and things of that nature is when you're thinking of your FICO auto score. So Vantage score is, like I said, it's calculated by one specific thing. But FICO has multiple different types that, and but like, for example, your auto score won't be the same as your real estate score. So based on what FICO score and what it's calculating is going to determine what that score is.
Okay. So you kind of like jumped ahead at another question. Is that there is the FICO 8, the FICO 9, there's the auto, the mortgage FICO, where somebody might be looking for an auto and they don't realize that there is a credit score calculated specifically for the auto industry. And also that the organization themselves can decide, like when credit models change, a business can decide that they don't want to adopt a new credit model. They don't want to pay into because could you help them understand like why some cards don't report to the credit bureau or why they choose a specific FICO? Can you help them understand that thing?
Okay, yeah, sure. So that's a two-parter. When you think about different creditors or companies reporting to your credit, that's because when the credit bureaus and those creditors have a contract, right? And it has a cost. That's why you'll also notice I have something that was removed from my credit, like we were talking about repairing your credit earlier in the week. I have something that was removed off one bureau, but it wasn't removed off the other one. This is because they're all for-profit companies. So these companies are actually paying per contract for everything that's on your credit. Some may only report to one bureau, some may report to all three, and some may only report to two. But that's based on the contract.
So guys, if you guys are picking up what she's putting down, if you guys have ever looked at your credit report and be like, how come this card is not showing up on my report? They have to pay a fee to report. And they're like, I don't want to pay for 3 companies. So I'm just going to report to this one credit bureau. And that's all they're going to report to. It'll never show up on the other ones because they don't want to. Right. So that's what's happening when you're only seeing a lot of times one card reporting on one debt reporting to one particular credit bureau.
And let me do something. I want to add something. I want to give a gem real quick.
Yeah.
A lot of people don't know the same way you can request to have items removed from your credit report. Guys, you can have items, you can request that good credit be added as well. So if you know you've had a positive payment history with an account, you can send a request letter to the credit bureaus to have that account report to your credit for those payments. So
that's good.
Yes, that is definitely something that you can do.
So you get it ahead, but I like it here too, because usually we're thinking like building your credit score just all together. You want to have on there because you're trying to have something established on there. But if you don't know what bureau loan that you're applying for is going to pull from, and you're like, this credit card is not reporting, but I have paid on time every single month. My credit score with this particular company is potentially lower than this company. I don't know which company they're going to pull from. I want to make sure that this positive reporting credit card is showing up on all the reports so that my score is as high as possible so I can get the best interest rate with whatever it is that I'm applying for. That's what she's basically telling y'all. I love that. And so something I saw recently, pivoting, is that one of the big 3 credit bureaus is getting sued again. Also, fun fact, the DMV here in Norfolk, I used to think there was only 3 credit bureaus, period. Those are just the big 3. There's lots of credit bureaus, but one of the very first ones, I want to say the very, very first one, is right here in Norfolk. That building that sits right next to my old church, the DMV, was the credit bureau office. Learned that random fun fact. I thought that was really interesting because I did not know that there was more than 3 credit bureaus. But anyway, one of the big 3, the ones that most people are reporting to, they're getting sued again. And at this point, this isn't new. So when you hear news like that, what should regular people be doing? How can they take advantage of these moments to protect themselves, dispute errors, or clean up their reports?
So you should definitely take 100% advantage of that. 1, pull your credit. Like we talked about, see what's on your credit, what's impacting it, what's negative. Because these major credit bureaus are being sued, they have to make sure that they are in compliance, right? This means your disputes begin to be handled properly. That's what helps you. And then in the case that it's not, now you have your data points to go further if they don't abide by what the constitutional law states that they're supposed to do. So I encourage you to pull your credit and send validation. You want to validate the information that's being reported on your credit under the FCRA, which is the Fair Credit Reporting Act.
That's good. So anytime there is a data breach, these organizations, like normally, they might be sometimesy with following procedure. But because they know that they're being looked at with a fine-tooth comb, they're going to go the extra mile to make sure if this company did not provide proper validation, they're going to make sure that stuff is going, because they're not trying to get no findings during this. Okay. So it's not, one of the things I was thinking is that like they had a breach and therefore you could just get stuff deleted, right? That's kind of like the thought, like, y'all, they don't send loans.
And honestly, that's because that's how it's perceived, right? And that's how it's explained. When you look on social media, they say, hey, this credit bureau is under fire. Dispute all of your accounts right now. And that gives the perception, hey, dispute everything is going to be deleted. But they don't give the explanation and understanding as to why. Why is it being deleted? Because they're actually going through the investigations like they're supposed to, something that they weren't doing before. Or they're going to not do that, and then you have your data points. But just disputing, if you don't know and understand why you're doing it, then it's not going to work. Because if they don't respond, you give up. Instead of knowing, no, I take this further because now I'm a part of that same class action lawsuit. And y'all have to understand, you get paid for those things. So that is more than enough time to start working so that you can be a part of it.
So one big question that I see and I hear all the time, and back in the day, definitely more common, and I don't know if the tides have changed because it's been a long time since I did credit repair work, but years ago, it used to be never dispute online because they have terms and conditions and those fine points when you're submitting online that says that if you submit your dispute online, you can't appeal it. And so if you go that route and they don't approve it, you SOL. But if you do it by paper, you have the opportunity to go back and forth. Is that still true? Or is it safer to dispute your a discrepancy online?
So I still encourage snail mail. 1, you have record. 2, you have your documentation. Okay. That's something that you can take with you to court in the case that you need to go there. It's still the same. Disputing online voids some of your rights. They do have some options for you to do that now, but I always recommend sending your letters in the mail. Now, you have to go a further step to where it's not disputing. That's when you start to have to do different transactions online. But that's ahead when you have, say, for instance, I hope I'm not giving them too much, but say, for instance, you have disputed with the collection agency, you've disputed with the credit bureaus, and they're failing to follow the rules and follow the guidelines that they're supposed to. You can then at that point file a CFPB complaint against those particular companies. That is something that's done online.
Okay. Guys, thank you guys for coming on in. I want to give a little love to the people in the audience. Tamiko Austin, she's in here. She said good evening. Jamie said hello, Coach B and Coach T. BT, we need to put that on a shirt, friend. Keisha said she's excited to be here. TikTok, I see y'all over here as well. Although the font is a lot smaller, so I'm having a hard time seeing it. But I appreciate y'all. Say hi in the comments. Let me know what state y'all are watching from. Guys, the state is super helpful to me to understand what my audience is made out of, because a lot of credit report laws are state specific. So if we can understand a little bit more about who y'all are and where y'all from, we know how to support you guys better. We know what specific information to pull up for y'all. So I'm over here in Virginia, but I'm by way of New Jersey. So I got a lot of Jersey people who be in my lives. I see we got some Virginia in here. Okay. Let us know, where are you watching this from? I want to know what state that you guys are watching from. Cashville. You know, Jamie, yesterday when I went, I had a real like blind moment. When y'all told me Cashville yesterday, I was just so excited about the idea that it was Cashville because I'm a money girl. You know what I mean? I'm a money girl. Of course, it didn't occur to me until I was driving and was like, I wonder if she's from Nashville. Like, I don't know, that it just didn't occur to me at all. Like, is Cashville Nashville? Did it take me this long to come to the conclusion? Is that what it is? It's Nashville?
Yep.
I like it. Okay. I learned something new. Cashville. Okay.
Yeah.
That's on my bucket list of places to visit. I heard y'all got good music, good food. She said, yes, Cashville in the house, come through. Okay. I learned something new. I was like, yo, I really was sitting here like, Cashville, I wonder where that's from. Where that is.
You put it together.
I put it together, okay? Later when you was talking about Tennessee, and I was like, oh, that's right. She is.
Now I know what you're talking about.
Okay. I'm ready. I'm going to ask again. I'm asking. Sometimes I'll be slow. I'll be smart and I'll be slow at the same time. Sometimes I'll be fast and I'll be slow. I'll be fast and I'll be slow, okay? I can't be smart all day, every day, okay? All right, guys. Yeah, I want y'all to put a number 5 in the comment because I want this to stick. Put a 5 in the comment. Put a 5 in the comment. Put a 5 in the comments. Put a 5 in the comments. And y'all, this helps me out because it helps push the algorithm and let y'all know that y'all active, y'all engage in this conversation. It helps bring people in. So we on here giving y'all free information. The way you can say thank you is, let me help you bring some people into the room by simply commenting. So if you guys can stay active in the comments, it means a lot to me because it helps me get other people in here so that they can learn too. We not selfish in here. I appreciate y'all. I see the 5s coming in. Okay. So I want to talk about what makes up the credit score. Can you break down the 5 factors and which one of these have the biggest impact? Now, I know, but I want to make sure that they know.
I got you.
Can you break that down for them?
Of course. So there's 5. This is my favorite part. I really want my following to know I've been here for a while. I really want them to put it in the comments because they know I talk about this all the time. But I'm gonna leave y'all alone today only. So
or y'all can pop y'all shit and put it in the comments anyway.
Put it in the comments with me, okay? Because I'm telling you, when you know this, you're good because it makes a lot more sense. It helps you understand where you need to build your credit and etc. So let's break it down. Number 1, I want y'all to put in the comments your payment history. Your payment history is 35% of your credit score. Okay. Number 2, that's your utilization. Your utilization is 30% of your credit score. Okay. Let me go back because I want to make sure I explain what they are as well. So I don't mess you up. Okay. When you're talking about payment history, 35% of your credit score, that is, of course, if you paid your open accounts on time, right? That's, have you made it past that 30th day? At day 31, they're reporting a late payment. Okay. It's also your collections. Because, of course, if you have collections or charge-offs on your credit, what does that mean? These are accounts that weren't paid that went into collections. So that's also calculated in your payment history. Utilization, 30% of your score. That's how much of my debt that I've currently been given have I used. For example, your credit card. If you were given a $1,000 limit and you spend $500 of that, you've used 50% of your utilization. Okay, so how much of the debt that I've received have I used? That's your utilization rate, 30%. 15% is your length of credit. Your length of credit is, and this is how they calculate length of credit, y'all, is the average of your oldest account and your newest account. Most of us that wanted to go to college after high school, if we've been out of high school for a while and we still have student loans, that's the oldest account we have, right? They'll calculate that oldest account with your newest account. This is 15% of your credit score. One of the things I like to recommend here, and I have to say this is one of the reasons it's really important that you don't go getting a lot of new accounts at one time because it impacts your utilization rate. Your length of credit. Because now you have more accounts that are less than 30 days old or 30 days And then you have not so many accounts that are older than 4 or 5 years. Okay. The last two are both 10%. That's your types of credit. How many different types of debt can this individual maintain? If that's installment accounts, revolving accounts, credit cards, line of credit, car loans, student loans, mortgages, things of this nature, personal loans. How many different types of accounts can they manage? That's 10% of your score. And then your inquiries is also 10% of your score.
You know what? I love to turn something into an analogy. I like to make a visual. Okay, and my favorite thing to connect things to is relationships, because I feel like it's something we can all understand. So I'm gonna spin at that, thinking about romance. So the way I think about it is your payment history is like trust, right? Do you do what you say you're gonna do? You say you're gonna pay, and every time you say you pay, you build in trust. Take some time to build trust. But the first time somebody don't do what they say they're going to do, that trust don't drop a little. It drop a lot.
Wow.
Somebody cheat on you. Oh, it take a little more for me to believe that you're not going to do it again.
Yeah.
I don't believe you. It don't happen. One more payment on time don't make me believe you, because you broke my trust. Right?
I like that.
What was the next one? Payment, utilization. How much faith are you asking me to have? Like, sometimes it's like people who talk a good game. You talk a good game. You ain't delivered on nothing. You using up a lot of faith. You ain't broke my trust, but you asking for too much of my faith. You ain't showing no proof. You utilizing way too much without evidence, right? Length of credit. What's your longest relationship? You ever talk to somebody and you like, the longest relationship you ever been in was a month?
Yeah.
I don't feel like you've been in a relationship long enough to understand what's required to be in a healthy marriage. I don't think you understand the highs and the lows of marriage. I don't know if I want to give credit to you. I don't know if I want to be your girl. I don't know if I want to be your wife. You ain't never had a long-term relationship, never? Don't nobody want you for longer than 30 days? What you doing? Fighting, arguing? Hitting them? What's happening?
Now I have questions.
Yeah. Okay. Types of credit. What? You have all kinds of relationships. So if you ever talk to a guy who don't have no friends, like no male friend, like I'm always leery of people who like don't have certain type, like girls who don't have female friends. Like, you don't have no friends, your family don't like you. It's not enough to know that you had a romantic, but it's one type of relationship you've been able to maintain. But how do you maintain your friendships? How do you maintain your long-term relationships, your family, the depth of it, right? They want to know you can handle all kinds of relationships. I got to be intertwined with your whole network, or lack thereof. That's types of credit. Inquiries. How many people are in your DMs? I'm sorry. If I gotta fight, I'm not trying to fight. Every time we turn around,
what is this?
At some point, I feel like you're going to fall into temptation. I don't feel like being bothered. You ain't deleted the app yet. You still collecting inquiries. I don't trust you. You clearly want something. You clearly need something else. You're not satisfied with me. You out here inquiring. You know what I mean?
Yeah.
Okay. It's the same thing. The same thing. You're looking for a healthy relationship. They want to see that you can handle, like, I feel like, especially with the types of relationships, like marriage is like your mortgage. That's a long-term relationship. And notice that's like one of the hardest ones to get. They want to see, like, how did you do with revolving debt? How did you do with an installment debt? Now, I want to see these other kind of, before I get into this 30-year commitment with you, we asking for a whole lot more.
Yeah.
That's it. That's all.
That was good. That was actually really good. I like how you put that together, because it's the same way when you look at your credit, right? Because we've given y'all homework to review your credit report. So when you look at that, I want you to do this. Think about that first date that you said you had high expectations of what that was supposed to look like. Okay. When you went on that date, your credit score, what did it look like? What did that first impression, what was it like? So the same way you feel, if you cringe, that's what lenders are doing. If you like, oh, this ain't so bad. I might do this again.
Mm-hmm.
Then that's what lenders look at. So start looking at it that way. And when you're looking at your credit score, no longer look at it from the consumer side. Look at it as if you were on the other side of the people who you're asking for this capital.
That's good. Thank you all so much for putting this in the chat. That's helpful. I can put it on screen. So in case anybody needs to take notes, you can get those notes. Speaking of credit scores versus credit health, because I kind of want to slide into that. What is the difference between, credit score and your credit health? Because people tend to chase the number, but don't understand what a healthy credit file actually looks like. Can you talk about that a little bit for us?
Okay, good. So the first thing, that's one thing lenders are going to look at. The scores may look nice, but your report plays a major role. You want to have a total of 5 revolving accounts. That's solid. This has to be not revolving, trade lines, which are active accounts, right? So that could be revolving or installment. You want a mixture of both. Revolving accounts are accounts where your monthly payments are going to change based upon what you use. For example, a line of credit cards, right? If you use a certain amount on your credit card, your monthly payment changes based on what you use. If you didn't use it this month, you may have to only pay the minimum. Installment accounts are loans where you're paying one set amount towards a total balance. So lenders want to see that you have you can handle a combination of both, right? What I've noticed is lenders like to see more Visa and MasterCards over store cards. They want to see that if you can use this line of credit in multiple places, how well do you manage it? Okay. They also don't want to see multiple accounts opened in a short amount of time. That's high risk. So if you've opened 3 to 5 accounts within a 30 to 60 day time frame, if you're applying for larger credit, it makes the lender look like maybe this person is in dire need of this credit, right? So you don't want to apply for multiple accounts. Give it a 90-day time frame.
Mm-hmm.
You're going to try to build your credit and add new credit builders or whatever the case may be. Don't do it too close together. That's going to be very, very important. And then you want to keep your inquiries under 10, preferably 3 or 4 if you can. Because a lot of credit applications, especially some credit cards, they'll automatically deny you because of the number of inquiries before they even get to your report. So it's always good to have a single digit of inquiries.
The way I'm spinning a block on our relationship scenario is when I think about like revolving debt or like credit cards, I think of that as like your sneaky link. Okay, you could spin the block on him. Like you could do that again and again, and you might spin the block, right? That's your sneaky link. I think of like boyfriend girlfriend relationship is like an installment loan. It's kind of a long distance, long term, but it's like not, you know what I mean? Like it's an end date. You know what I mean? Marriage is the mortgage. They use a longer commitment when we talking about relationships. Okay, you got a bunch of sneaky links. You probably
in a short period of time. What does that look like? Right? So it's the same.
Like you're a hoe. It looks like you're a hoe. I'm gonna go ahead and say it. You look fast. You look fast. You look like a hoe. You're letting everybody swipe.
You ain't
I bet y'all never forget this though. I bet you never forget it.
They're gonna go pull up a credit application like, no.
Here I go again.
I don't think
just paid off this credit card and I'm spinning the block like the dude. I said I was gonna leave you alone. Here I let him slide back up in my DMs. Here we go again. I can't leave him alone. It's so good. It's so good. Yes, not the swipe. Yeah, I use that example. I'm gonna post the clip too. She told me to post it with my client. I was talking to her about saving and spending, and I don't want to lose the plot for y'all, but spending when you don't have no boundaries with your spending, you're a debit card hoe. That was what I told you. You're a thought, which is your debit card. So I like that. It helps y'all remember it. I'm telling you right now. Every time you swipe your card, you're probably thinking like, I am not.
They go like, ma'am.
I'm not your regular financial coach. It's not going to be boring in my sessions, friends. We're going to have a good time. We're going to have a good time. Okay. Thank you so much for explaining that to the audience. I hope this is helping y'all. I'm here seeing a lot of I like that. Appreciate y'all. I see y'all. What is it? Mommy said it in the car. Welcome back. She came back. I appreciate you. You came back in TikTok. Wait, you said, oh, wow, I'm guilty. It's a lot of thoughts in these comments. I see. It's okay, friends. You could be recovering. Don't let nobody ever tell you can't tell a hoe into a housewife. You can. You absolutely can. You can.
I'll put all her cards in the freezer in a cup of water. Watch.
Yes. We on a mission. Okay, so credit file. The way I was thinking about like credit file versus credit score when you were kind of explaining like those distinctions is I think of it like your report card versus your GPA. Like your credit report is when you first look at that report, you're looking at like your grades over multiple quarters, or you're looking at your transcript over your GPA is telling a numerical story, but it doesn't always tell you how you got to that number. Like your report card is that look to see you got an A in this class and an F over here. And just because you're doing really bad in one particular area, you could do really well in another area that helps bring up your score. So because there's some areas of that credit score that you just can't fix overnight, like length of time. That's not something that you can't just fix that overnight because it's got to age. Like that's something that only time can resolve. You can mess it up overnight by closing the score, by closing a card that's your oldest card. But as far as like increasing that age, that's something. So if that's bad and it's like, dang, I nothing I could do about it, you can work on the other areas of your credit score, right? So, okay. How often should somebody be monitoring their credit file or monitoring their credit report?
To be honest, monthly. If we're talking about the minimum, monthly, because one, annualcreditreport.com allows us now since COVID to pull our credit report once a month. So I
was going to ask, did that ever go back? So it's still once a month. Love it.
And if you are a person who has any government benefits, you can also pull your credit report for free. So, and then of course we know if we were denied credit or anything like that, we have those reasons you can pull it as well without a fee. Check that. I recommend looking at your full credit report at least once a month.
Okay. So in the past, when it used to be that you could only pull it 3 times a year, what I would do is I would do quarterly. I would pull from one file in Q1, another file in Q2, another file in Q3. And now that is every single month, all 3 of those you can pull every single month, right?
Yep.
So there's really no need to like separate. You should be looking at all 3 of them to see if there's any inaccuracies on all 3, right?
Yes, because remember, they're for-profit companies. So because they're for-profit companies, they report things differently based on the contracts that they have with the creditors. Just because some of them have the same information, they're not together. So pull all 3 because you may see something on one report that you don't see on the other. Or what you also can do is cross-examine them, right? If you have an account that's reporting to all 3 credit bureaus and the balance is different on all 3, isn't that not an inaccuracy? That means at least 2 of them have to go, if not all 3. So these are different things that you can look at. So I definitely recommend you pulling all 3.
Thank you for that. Mommy said, thanks for that. Thank you. You're welcome. If you guys have any questions, put them in the chat so that way I can make sure they get answered before we get off the live. So let's talk tools, because credit confidence is about building with consistency, and it's a lot easier for you to check your credit score frequently if you have a tool that's user friendly, that's reliable. So first, let's talk about secured cards. Can you talk about what's the difference between a secure card and an unsecured card, and when you should use each?
Yes. Okay. So an unsecured card is your money, right? It's where you're securing your credit limit with funds normally from your savings. This is normally something that consumers do when they're building their credit, whether it's rebuilding or building for the first time. You may not be able to get approved for an actual credit card with other banks, so you're starting somewhere. That's when you use a secure card. Unsecured cards are cards where the bank is giving you capital without you having to have any type of collateral. You don't have to put a deposit or a down payment, and they'll give you a limit based upon your credit score.
Okay. So would it be fair to say an unsecured card for somebody who's like we talked last night about bankruptcy, right? They file bankruptcy or their credit score is a 400 and they're trying to build it up. They can't seem to get approved for a traditional card. The unsecured card is a good first start to rebuilding their credit.
Yes. And I'm going to be honest. There are a lot of different options that you can get when you're talking secure cards. I always recommend doing it with your bank. Here's why. Relationship building, Coach B talks about that all the time. She's talked about it every day, right?
Yes.
Relationship building. If you're building a relationship and you're showing your bank that you can manage money well, you can manage credit well, you can request that they approve you for an unsecured card. Normally what'll happen is they'll give you the option to get your deposit back, and it goes into your savings or your checkings depending on the bank, or they will change your card from a secured to an unsecured card. So you definitely have options to convert. And there are some banks, Navy Federal is definitely one. They're really good at building an internal relationship.
Just about to say that.
So
they have an internal credit score.
They have an internal credit score. So most people who have them, getting that secure card, getting that pledge loan, building those relationships, then you can apply for another card and they'll give you more. If you and someone else with a 650 credit score applies for this rewards card, they would give you more because of your internal relationship than they would the person that probably has the same credit profile.
Mm-hmm. And not only that, to relationship building, sometimes your bankers have, they can talk to the underwriter. Sometimes they give you a denial, but then because of the conversation you had with them, they can override an initial denial. So having those conversations, especially if it's like you're trying to, you have a specific utilization that you're using it for, there's a strategy here and it makes sense to them, like building those relationships matter. I heard somebody tell me just in the business boot camp, it was one of the bankers for we're in the process of piloting a funding program to get small businesses in the 757 area loan funding through Chesapeake Bank. And I was talking to the banker there, and he told me that, working with multi-million-dollar accounts and businesses over the year, one thing that he noticed about really, really wealthy people is every last one of them knows their banker's name, and their bankers know their name. And I thought about that, like how often, who do you know by name at your bank? And then I thought about why somebody that wealthy would know their banker's name. Because if you got that much of my money, I want to know who you are. I want to know everybody in here. I want to know you because you're holding on to a lot of my money. And I was like, okay, from now on, I'm going to make a point to know who my banker is and for them to know me. To me, that's like more of a mental first step. Every millionaire knows their banker and their banker knows them. I'm already doing one thing a millionaire is doing. I know my banker. I know their name. So, to that point about building relationships, that first start when they really know you, they see you trying, they may be able to make to work with you in spite of where you're going at. Like that's a really good point. Thank you for highlighting that, guys. This is good.
I do want to add and piggyback off of that too. When you talked about a banker, right? That was a pinpoint for me, and here's why. I want the people who may not have a bank that has a local branch where you are to really consider that. No, it does not mean go and change everything over, but you do want to be able to go into a branch or be able to talk to somebody, like she said, a banker, right? That you can talk to, because not only can they talk to underwriting, but they can teach you some things. They know more about the product than you know about their products, right? So if you want to know what's best for you, your banker would know that because they see your finances. So
Mhm.
that's a first step. You may not be able to afford a CPA, right? But if you could start somewhere with understanding the banking products, you may be able to make some better decisions on what products work better for you.
Speaking of products, what are the best secured cards or credit building tools that you recommend for somebody starting from scratch or rebuilding?
I told y'all something yesterday. Do y'all remember? Y'all was supposed to take notes, so put them in the comments because I want to remember.
Do y'all remember at least the two? Yeah, because she gave y'all two tools yesterday. I want to know who's here from yesterday who remembers the two tools she gave us yesterday. Put them in the chat if you remember what they are.
And while y'all are typing, they're short, so I know it's not going to take long, right? One of the other ones, and I'll go back to those for our new listeners. One of another favorite one that I have is Self. For those that are building your credit and you're trying to, um, create accounts and trade lines, positive accounts to your credit. One thing that I love about Self is it starts as an unsecured loan. So it's really a CD account. What you're doing is you're saving, but it's actually reporting to your credit as if you're paying a loan, right? It could be, I think now it starts at $25, and then you can choose the amount that you want to put into this savings. Every month. It's going to, of course, charge your card. And then it's going at the end of your term, I think they have 12 and 18 months. You have the choice to have this deposited into your account. So not only did you save some money, right? But you also had to report into your credit as an unsecured loan. Within 3 months or $100 into the program, they'll qualify you for their secured card. They'll take the money that you've put into the program, and then they'll give you a secured card with that. Now, this goes back into your 5 components of the credit score. This is helping you with your types of credit. How many different types of accounts that I have? Now you have revolving and you have installment with the same company. So I really do. A Self is one that I really like. Did they get the other two?
Let's see. Let's see. Did y'all put them in the comments? Do y'all remember? You said Self.
I
Self
see
is
Grow Credit.
one.
Yeah.
Y'all Self over here on TikTok. Grow Credit.
Boom.
What's this? One more. It's one more she gave yesterday. It's a girl's name. Sounds like a girl's name.
That was good.
Little clue. Little clue.
Mm-hmm.
While they're still thinking, here's some other names I want to throw out, and you can tell me what you think about them if you've heard of them. Chime, Credit Builder, and Kickoff.
Kickoff. I like Kickoff. Because it's helped a lot of the legacy builders in the legacy group build their credit. And it continues to evolve with the products that it has. So I definitely would recommend Kickoff. Now, Chime Credit Builder, I have mixed emotions about, right? It does help you from a payment history standpoint and having positive payment history reporting to your credit. But one of the things that I've noticed with the Chime card is because I think you deposit the money that you use for the credit. Every client that I've seen use it, it has their utilization reporting at 100%. So this can impact 30% of your score. Although you're at 35, it's still impacting 30%. So I don't normally recommend Chime. I recommend doing a secure card with your bank. Or there's a Capital One secure card that starts at $200, not Credit One. I don't care for Credit One. It's kind of expensive. But Capital One, their secure card is really good as well.
Good. Okay. You want to give them the two from yesterday?
Yes. And the two from yesterday was Grow Credit. If you have an AVA and Grow Credit, they both do the same thing. If you have monthly subscriptions like your Netflix, Hulu, Apple Music, put your monthly subscriptions in the comment too, because I want to know what y'all use. Also, your phone carriers are on there as well. For my business owners, Canva's on there. I love that. You can actually use these apps to report those subscriptions to your credit. It reports as a virtual credit card. So now you have that revolving account reporting to your credit, and it only only reports, because it allows you to do a certain amount of subscriptions, it's going to ensure that you're only reporting 1 to 5% of your utilization with that virtual card. So that's going to help you with your utilization. It's going to help you with your payment history as well as your types of credit as well. And it does not take an inquiry to get either one, so you're not impacting your inquiries.
Oh, thank you. Thank you. Thank you. Guys, if this is helpful, please say this is good in the comments. This is good in the comments. Let me know. Is this helpful over on TikTok land? I would appreciate you. I appreciate you in here. You've been in here so consistent every day. I need you to give us updates. If you're taking action on some of these tips that you've been getting over the last couple of days, I need you to spin a block on us. DM both of us as you take some of these steps. If you make some progress, let us know, because we like to hear these little praise reports. Okay. Thank you. This is helpful. Double tap the screen and share. I told you I don't got a selfish community, so I know y'all hitting the share button for us. So let's talk about authorized users next. Is this a good strategy to build credit, or is it risky? And I want to talk about I want to talk about a certain type of authorized user after this, but I'm gonna speak in general first.
Okay. So it is a good idea. Great idea. Because just like how we were talking before, it takes time to build your credit, right? So having a family, let me make this really, make sure y'all hear it. Listen, a family member that has good spending habits, a family member that has great credit. Because if they have great credit, that means that they're paying their bills on time. Because your payment history their payment history is now going to be your payment history. And if they get a late payment, you get a late payment. And it's not as simple as, oh, they got a late payment, now I want you to take me off. It's still going to show. The same way the positive payments would as well. So I recommend it because it helps you with that length of credit, that payment history, that utilization to increase your score if you have younger credit age. But it has to be with someone who has great credit that you can trust with that, because the same way it can really benefit you, it can impact you too.
See, you got all in my business, because that was my next question. All in my business. I was going to ask you, what about parents who add their kids as authorized users, but don't have good credit habits themselves? A lot of times, I think parents have good intentions. They're like, man, if I had known my mama could have put me on her credit score, I could have started off with a 750 credit score. If she had put me on their credit score, I'm going to do that for their kids. Completely disregarding the fact that they haven't yet developed good payment habits yet, good credit habits yet. And so, well-meaning, they put their kids on their credit report, and then it backfires and it messes up their child's credit before they even get started.
Yes.
And so if, as a parent, if you really want to help your kids get a head start on credit, the first thing you got to do is get better credit habits yourself, because your own behavior is going to train them to begin with. Just watching what you do and how you manage money, how you handle credit, what you say about credit, how casual you are about using cards, and your language around it matters. And then once you have adopted really great credit habits, then it might make sense to add them to the card. But I'm gonna tell you, if you do, that need to be a card that you put on auto pay, a card that the only bill you got on there is like a utility bill, something you only needed to use and can pay off really easily. Don't play with your kids' credit and have that be the card that you swipe at Christmas and then life on you and you mess that up. If it's a good idea for you to do it, but think about that fact that your decisions, your behaviors, you could have a life event occur. You could be great with paying your credit the whole time, and something crazy happened, and now you are in a situation you don't want that card to be, your child to be on that card that had a $13,000 credit limit, and then you lost your job. Right now, a whole bunch of people just got furloughed. And if you had your child on that $13,000 credit limit, now you don't know how you're going to make a payment on that card that you've been able to do this whole time. Now, these kids whose credit scores you've been building, we're potentially damaging them. So we want to be really careful with the ones that we put our kids on. Yeah.
And then also think about it like this too. A late payment is reported at 31 days, right? I think by 15 days of your due date, you know that it's probably not going to happen. whether you want it to or whether you don't. The responsible thing is parents that are looking to build their children's credit. If you get in a situation like that, this goes back into that talk to somebody, right? Don't impact their credit. You can make a phone call. A lot of times companies now, you can update it in the app. Take them off if
Mhm.
it's before this happens, right? You don't want to wait until after it's going to report. Take them off prior to, so that way they're not impacted. And then when you're ready to start over, then now it's going to show as a closed account, but they have your previous payment history. That way it only taints you if that happens, not. So this is one of the things we also have to think about, because once we add them, we can't forget they're on there, right? We have to know this is the card that my child is on. So you're gonna have to make sure you make those adjustments in the case life does happen.
Mm-hmm. Another thing that I want to remind you guys, because the furloughs are happening, there's a lot. I'm in a big government community here. I forgot you're in Virginia now, so I don't know how many military bases you have in the part of Virginia you're in, but a lot of government workers here, a lot of service members here, and something that a lot of people don't realize is that sometimes your credit card comes with unemployment insurance, and you could lose your job. And I'm speaking to you to this from a place of it happened to me. Is I had a credit card, probably like one of my very first like big girl credit cards. And I completely forgot. I remember seeing that term and condition. I remember signing up for it, but I forgot about it. And I also I didn't know how it worked. I had an option of adding it on. I think it was like $1 or something. And I forgot how it worked. And I found out after the fact, like, oh, you had unemployment insurance. You could have called, activated it, and it would have allowed you to pause your payment so that you're kind of like the way your student loans, you put them things on deferral. So you don't have payments during that period of time, that you get a period of time where you don't have to make payments and it's not reporting late because you had unemployment insurance on your card. So I encourage you to, I was probably like in my early 20s at this time. I encourage you guys to contact your credit card companies and find out what benefits you have with your cards, things you may not have realized, paid attention to. You can throw away the little piece of paper with all the perks on there so that you understand what your options are. Should you ever experience disability? Should you experience a loss of job? Because sometimes there's disability insurance attached to your cards, not always. But find out what it is, because that can definitely help protect your credit or your child's credit if they're, you got them as an authorized user at the time.
And if you have a rewards card, check your rewards, because you may have accumulated a ton of rewards and didn't know it, that will cover those payments.
Oh, that's another good one. I got a good question on TikTok chat. They asked, what are your thoughts on Afterpay, Klarna, and Affirm type programs?
I am all for them when we're talking about something we can manage. You don't get more than you can afford. What I will say, they do report to your credit. So this isn't something that you want to mismanage. That's the first thing. If you're looking to buy a home, absolutely not, right? Lenders don't like to see the Afterpay and the Klarna and the Affirms. So I would recommend, 6 months into preparing for home ownership, that you minimize the use of them, because remember, they do ask for your bank statements and things of that nature, and you want to ensure that that doesn't impact you in underwriting.
Mm-hmm. And when they apply for a Klarna or Afterpay, is it reporting one giant Afterpay, one giant Klarna, or is every little loan that they're taking out showing up as a separate thing on their report?
Every single one is different. So every order that you make, it shows up. So if you have 4 and 5 out and life happens where you decide to stop paying, all of them will show.
This is what I really wanted y'all to hear, because I know a lot of people think that it's just going to be one of that company is just going to report as opposed to multiple. And remember, we talked about a bunch of sneaky links, a bunch of inquiries, a bunch of stuff landing on your page, like how that's going to affect you. Yeah, she said, "Wow, that's great. Thanks." Yeah, this is why we're having this conversation, because I want you guys to know these are new types of credit. These credit types weren't around, so long ago. We're getting ready on Christmas season, and you're gonna have a lot of predatory, We just afterpay it, just Klarna pay it. And sometimes it's necessary. Sometimes you have to do what you have to do. But we just want you to understand the implication, especially if you have a large purchase like a home in mind in the near future, how that's going to show up, how that's going to affect you. Does it affect the credit age? Have you observed that?
I feel like it would, right? Because you have so many new accounts and they're reporting open. So I haven't directly seen it decrease with scores with the clients I've seen use them.
Mm-hmm.
But I would say for someone who is new in credit, it's going to decrease your credit age. And, that's 15% of your score.
Okay. Let me look at some of the comments over here. And she said, did y'all say they have to be 13 years old in order to add them? I'm guessing as an authorized user.
That depends on your bank. You have to call in because some banks allow your child to be added as young as 9. Some are 16. There are some companies where they have to be a specific relative, specifically in your household or your children. You couldn't do an aunt or a niece, things like that. But it's different based upon the financial institution. You would have to call and ask or look in your app because it will tell you.
Okay. Another thing I want to talk about is that everybody's selling or talking about trade lines, right? And people are buying them like hotcakes. Can you talk about this? Is that a setup if you don't know what you're doing? Is it a good thing? Is it a bad thing? What are your thoughts about that?
So I don't see anything wrong with purchasing a trade line if it's going to build your credit. And just like with anything else, you need to ask questions, right? Who is the affiliate that you are being serviced? If they're not giving you a contract, you don't want it. If they're asking to send it via Zelle, Cash App, things of those natures, you might not want it, right? Because in the case that your services is not rendered, how do you get your money back? Right? Those are the things that you have to think about. Those are the things you have to look at. And then also pricing, right? I don't recommend that you spend $20,000, $6,000 on a trade line. You may have a family member with good credit that can help you. They don't. I wouldn't do that.
So can you, because I feel like I may have skipped a step for some of the audience members who are like, what the hell is a trade line in the first place? Can you help them understand what this is, what they're buying?
Exactly what we were just talking about. It's an authorized user account. So what you're doing is you are being added to someone's credit card in order to obtain their credit age and their utilization to increase your score. So the same way you would do if you're asking for a family member to assist you, or the same way you would do with your children, is what you're actually paying for, right? Which is why I would recommend, if you have that family member, to ask. Another thing that's important to remember is a lot of times when you're purchasing a trade line, you're actually purchasing it for 60 to 90 days. So think about the amount you're spending and the time that it's going to report, right? That means that whatever it is that you're looking to do from a capital standpoint, that's the time that you're supposed to do it. If it's a family member, you have a little bit longer time to leverage that as you're building your credit than purchasing it through a company.
And I can imagine that this is risky on both sides of the transaction, especially when we talk about, we start getting into, and this isn't so much like trade lines, but co-signing specifically. Can we talk about boundaries, co-signing, how to know how to know when you should or you shouldn't? And I think this is a conversation that's not just about like your cousin, your sister and them, but your spouse. What have you observed occur and what is your thoughts around it?
Co-signing scares me for a lot of reasons. Because you have to, does it help build your credit? Yes. If it's something that you are going to be okay with managing long term, yes. But this is what you have to remember, whether it's an apartment, a mortgage, a car loan, any of that. When you're co-signing, you're not just saying, oh, I'm going to help this person to apply for this loan and to get approved. although that's what we're initially doing in our mind, that's not what you're saying. What you're saying is, on this credit application, I am taking full responsibility for this particular account. So if this person is evicted, it's on your credit too. If you go to court too, you're sued too. If it's repossessed, it's on your credit too. You're sued too. And if they have a late payment, it impacts you as well. So I don't recommend co-signing if you don't plan to have and be okay with taking full responsibility. If that person can't pay, can you comfortably?
That's a perfect question to ask. If this person can't pay, can I? Can I? It's something that I have my clients do when they tell me, like, I'm paying for, or my child has a car loan, but they're paying the loan, but it's showing up on your credit report. Mm-hmm. I'm putting it on your budget. I'm putting it on your budget. Why? Because I want you to understand what you can really afford. While we hope you never have the liability of paying that debt, I need you to know you have the liability of paying that debt. And I need you to not burden yourself with additional monthly payments under the assumption that you have that extra $300 a month because they're paying it, because God forbid they lose their job, you're on the hook for it. You need to be able to comfortably pick it up, or you're going to jack up your credit. So we need to put it on now. Now, what you do with it, obviously, you're not actually paying the car because your kid is paying the car. But I need you to treat it like you got to pay it. Where are you going to put that? You're going to put that in your savings account. You're going to treat it like a bill that you got to pay. You're going to put it in your savings. Now, God forbid they really do, it's still not coming out of your regular paycheck because you got savings to cover it. You got cushion. And then best case scenario, they pay it off. You got all in savings.
Mm-hmm. And also remember too, when you're thinking about applying for something, that goes towards your debt to income ratio as well, because that is your debt as well. So you have to remember that.
Mm-hmm. That's such a good point. That brings me back to like credit health specifically, because some people will be like, why did I get denied for this loan? I have a 800 credit score. Well, your credit score is high, but your debt to income ratio is crazy. And they're not looking at your debt to income ratio when they're approving your loan. I mean, as far as your credit score goes, they're looking at your credit utilization, but that doesn't have anything to do with your income. Mm-hmm. That's talking about how much of the credit they lend you that you're actually using. But they're looking at like, no, you are already overextended. You're a risk. Despite your score, you have, based on your income, we don't feel like you could afford to take out more credit. So it's a no.
Yep. And that's what I talk about with homes too. I always tell my clients, your credit score gives you the yes. Your income says how much. So I gave it to you, but how much? So based on how much capital, that utilization, right? Think about that. How much do you have based on what you make?
Mm-hmm. How much can you afford to pay? Okay, so if somebody's utilization is already high right now, well, what's the fastest way to bring that
down? Multiple cards or just one? Multiple cards?
Either way.
Okay, let me start with multiple cards, because most of the time, the reason you can't bring it down is probably because you have more than one that you're paying, right? Paying the minimum keeps you from getting a late payment, but you got to remember you have interest. I always recommend paying off the card that has the highest interest rate first. Why? Because you're paying out more each month. If your balance remains high on that card, that monthly interest rate is going to keep your payments, higher and your balance higher. If you do that, of course, you have to pay the minimum on your other cards. And anytime you have extra, pay more towards that. But always focus on the one with the highest interest first. Now, when you're talking about, even with this just one card, if it's one card, the best strategy, you can't really do this if you have multiple, but with one card, you want to try to make more frequent payments. Okay. Because some credit cards now calculate their interest the same way car loans do. And that's daily interest. So that means every single day you're being charged interest on your total balance. If you pay more frequently, whether that's instead of paying once a month, paying twice or every single week, that's going to increase your balance so that your interest payments aren't high.
So let's talk about another strategy, which I like, is Again, this is for credit healthy people. People, because this can be a slippery slope if you got bad habits, right? Is opening up a new line of credit in order to improve your credit utilization rate. Can you talk about that?
I do not recommend it. Highly not recommend it. Here's why. Because although it helps your credit utilization, you still have that balance, right? And I never, of course, we know we don't want to use one credit to pay off the other one. That in a lot of companies don't allow that now, but I would recommend you focusing more on lowering your utilization than adding more credit, because when you're adding more credit, remember you're still impacting other parts. So where you're helping your utilization, there are other parts that you're impacting. Those are the moments where you ask yourself, and that's why those five components, understanding those five components are important. You have to ask yourself, is this going to impact me in another area that's going to be more of an impact if I do it or if I don't?
And for those of y'all who are trying to make sense of what she's talking about, like if you get approved for another card, you may have decreased your credit utilization because maybe you went from using 50% to 25% because you got another $1,000 approved, and that improved that 30%. However, you got another inquiry and you decrease your credit age. So those two factors are affecting your credit score too. And that's one of the reasons why sometimes people ask me, like, I just got approved for a house, or I just bought a car and my credit score went down. It's a temporary drop because the only thing didn't happen is you just got approved for a loan. You also got an inquiry, and you also adjusted the age. So that's what's affecting you initially.
Yeah.
Okay, so tools. What are the best free tools or apps for monitoring credit and getting alerts when something changes? Or should they be paid?
You can. If you're looking to purchase something, apply for any type of credit, I always recommend MyFICO. Why? Because MyFICO is going to show you every single FICO score that the lender could possibly pull. One thing I didn't say earlier that's really important is you have the right to ask what FICO score these companies are using. So if you have a loan that you're applying for example, a mortgage, you can ask them what FICO score they use, right? My FICO is going to be my number one pick, because it's going to show you those FICO scores. The closest credit monitorings that I've had that get you the closest, if you really want to identify your score and it to be close as possible to some of the FICOs, is closer to the FICO 8 score. There's My Free Score Now, which is really good, and Identity IQ. One thing that I love about those as well is they have additional tools inside of these systems. So a lot of people only use credit monitoring simply for reviewing your credit. But a lot of these particular platforms, you're paying monthly for identity protection, alerts, all of that. They even have some money management tools on these two platforms, I know for a fact. So I love my clients when they use them and actually say, hey, Coach T, I have this money management tool that I'm working on and I really like it. And then they're explaining to me what they're learning from it and how it's helping them. Because remember, those behaviors actually impact your score as well.
Okay. Guys, I hope this has been helping y'all, because she is giving y'all so many gems on how to build, how to understand your score, how to understand your report when you're looking at it. And if you guys are not taking down notes, I just really don't. I don't know why. Especially because we put them on the screen tonight. I even remember to use my tickers. So imagining that they've rebuilt their credit score. Your credit score is looking good. How do you keep it that way? How do people avoid falling back into debt cycles they work so hard to escape? What daily or weekly habits have you observed help their progress? I know what I see on my side. I'd love to know how you see it on your side.
One, check your bank account daily. And I know y'all saying, oh, that's normal. I do that anyway. I'm not talking about for your balance. I'm talking about for your spending habits. Analyze, what did I spend today? What could I have prevented? Where could I have put this, right? Because that creates the habit. You also want to make sure that you're checking your score as frequently as possible. The biggest thing is to keep yourself from getting back in the same situation that you were in. Don't create the same habits. If you're not comfortable and confident with managing multiple types of debt, don't apply for multiple types of debt. Make sure that they're actually going to be beneficial for you as well. Because what a lot of people are doing now, they see a lot of posts circulating, especially when you have consultants that are giving you different credit gems and different credit builders that may work for you, and they're applying for everything that they see. Find the ones that work for you. Find the ones that go for your budget, and also start looking for interest rates. A lot of times we apply, and because they say yes, we take it. If the interest rate doesn't make sense, don't do it. Right? Think of that, because I love how Coach B, she puts some type of visual with everything. Think about that as your how do you feel about yourself? What are you going to tolerate and what are you not going to tolerate, right? If they're giving you, if a credit card company is giving you a 22% interest rate and you don't feel like that's what you want, continue to do your rate shopping, or it does not mean that you have to open it if it's not going to work for you. So start asking those questions, researching. Don't just apply because you saw it. Actually learn about the product before making that decision to see if it's going to benefit you and your household.
That's good. I like that because to me, like that speaks to both internal and external boundaries. Having, in my observation, one of the exercises that I do with my one-on-one clients and my clients that are in my group program, they get this in their curriculum. We don't do that in 8 weeks, but they get to take it with them to work on throughout the year, is understanding the life cycles that put them in debt in the first place. What were the life events that occurred where you needed to swipe your card? Was I depressed? Was it a car thing? Was it a death of a loved one and I had to travel out of town? Was it, when you start to understand the life events that you use a card for, then you can start to understand like what categories have I not been budgeting for? And then you can start to put that in your budget more effectively. You can start to have pop-up or sinking funds. A lot of people like to call them. I like to call them pop-up. It's pop-up savings because, baby, don't nothing sink in our life. You can start to build up the right savings account so that you don't use debt. Because in my observation, a lot of times people want to come in here like, I just want to, they come to me and then right away they're like, I want to pay off my credit cards. And I know you do. But here's what I know for a fact is you're going to end up right back into debt if you don't have savings. The first time you need a tire blown and you don't have any savings, you're going to have to put it on your credit card. So we have got to fill the holes in your bucket before we start being aggressive with debt straight up. Yes, you have to pay off your minimum, but we need to make sure we have some cushion so that you don't have to go into credit card debt again. So to me, working with my clients on a regular basis is you need to fill the holes. If there's a particular process I take my clients to, I have them do this assessment on the 5 financial frustrations to figure out where their holes are and their bridge. Those early pillars cannot be skipped. They can't be skipped.
Yeah.
You gonna want to save, but if you in the red, you out of line because it don't matter what you put in savings. If you in the red and you're meaning your expenses exceed your income, you're gonna be pulling the money right back out of your savings anyway.
Right.
So there's an order in which you address improving your finances so that you don't find yourself back in these cycles, and that's a step. But if you also don't understand the inner stuff, which is why I have my clients when they're working with me, I say my class is not just for budgeting. It's not just a bunch of numbers. I do the root work. Thank you so much for the heart, me. It's not just about numbers. I make my clients do the root work to understand themselves more deeply, because sometimes it wasn't about not having savings. It was about something that was going on in their life. And if you don't understand these stages of life or how other people affect you, that, when you get around these friends or this family member or the holidays are coming around, the holidays can be very triggering for a lot of people. A lot of people go into a lot of debt because of a lot of internal pressure that they don't even realize they're experiencing when they're around their families. And if you don't understand that, you're going to do all of this work that Talisha just taught you to get out of debt. And in a year from now, you're going to be right back where you are. That's one of the biggest complaints that I have, that I get from mortgage lenders, real estate agents, credit repair specialists like you. They're like, I need you for my clients because I've done all this work. You have done all this work to get their credit report clean. And then they're back here a year from now because something didn't change. Something didn't change. And I liken that when people change their score or change their savings balance, like they're like, I'm waiting for tax season, I'm waiting for this influx of money or whatever. and they think this one magical thing, I'm gonna get a raise and that's gonna be the thing that changes the thing. That's a temporary fix. You're gonna be right back where you are if you never do the root work. I promise you will. It's temporary. It's going to be like if y'all in my class, you already know when I talk about the root work. Like your mindset is a thermostat. Your mindset is a thermostat. Whatever temperature it is outside, it'll temporarily change your situation, but the thermostat's going to put on autopilot and put you right back to where you've always been.
Yeah.
Period.
Yeah.
So if you don't change your mindset, your thermostat doesn't change temperature, you're going to get that extra money, that extra raise. You're going to fix your credit score that one time, and you're going to find your way back, right back to where you used to be, where you always been. Because that's your normal. That's your ceiling.
And that's one of my sayings. I always say, shift your mindset, shift your money. Because you got to shift the way your mind thinks so that you can shift the way your money moves.
That's the bar, y'all. Put it in the chat. Shift your mindset, shift your money. Okay. Building self-trust. Let's get into that, because this is kind of like a perfect segue. Because you and I both know that if you don't trust yourself with money, you'll misuse credit, no matter what your credit score says, if you don't trust yourself with money. So what are some ways that you feel like people can start building self-trust with credit after years of fear and avoidance?
Take it slow. Think about the visual of your relationship, right? If you're getting back into a new relationship, what do you have to do? Take it slow. You have to give yourself time. Don't try to rush into it. A lot of times we fear because we try to do too many things at one time. Make it understandable for you. What you're working with and what you're. That's important. Take it slow. Get a pen and a piece of paper. If you're more of a digital person, use your notebook on your electronics. Write these things out. The most important thing that I say, because it starts with, when you're thinking about credit, it's attached to your money, right? And you have to make sure that the credit that you're using, you got the money to pay it back. So you still have to budget, regardless of if it's credit or if it's monetary, or if it's actually the money that you're making from your 9-to-5, from your business that's in your savings. It still has to be paid, right? So you have to remember that. Write down the things that you desire. Write down the things that you need. What am I using this for? What I try to do with my clients starting out, especially once they've graduated from your AVA and your GROW account, and they're ready to even get a secure card, what are you using this card for? Is this your gas card? Is this your utility card? Is this your daycare fee card? What is it for? And discipline yourself starting out to establish the payment history and making your payments on time. Use it for only that. And then as you get comfortable, maybe add something else. And then after you've gotten so comfortable using that card, then go get another one instead of jumping into multiple at one time.
That's good. Deborah, she said, thank you for becoming a fan. Debt cycling. Yes, true. Something that made me think about like going slow is like, if somebody did break your heart and you're trying to rebuild trust, go back to relationships, it's like you have the access you give them is limited. You slowly increase access. Like, we'll see. You know what I mean? The amount of credit limit you allow yourself to have access to, I always start with a small amount, even if you can get approved for a larger amount, because I don't know if I can trust myself with that amount yet. So until I can feel and prove to myself that I can feel trustworthy with this amount, I'm not even going to ask, even though this might help your credit score to ask for more. Right now, we're not worried about the score, especially if you're not trying to buy nothing. Right now, I'm worried about rebuilding my habits and my trust and my ability to manage this well. And I don't want to even give myself opportunity to mishandle $1,000. I really want to just allow myself to be trustworthy with $250. And when I'm doing that consistently over time, then I might be able to give a little more trust in a relationship after you seeing somebody build. Because I think that the only way trust is built is over time. It's like if you ever sat in a chair Like most of the time you sit in a chair, you don't think about it. You just assume that the chair is gonna be good,
Mm-hmm.
right? But you ever sat in a chair that the leg broke, and then the next time you go to sit in a chair, like every time you sit
Pushing
in it for
down.
a little while, that one particular chair, you kind of look for a while until you sat in it enough time that you feel like, okay, it's really
Mm-hmm.
fixed. Like it takes a little while before you, because your brain remembers that broken trust.
Yeah.
You got to give yourself that repetition to be able to build up trust. And one
Mm-hmm.
thing I always say is, until you have good habits, you need good systems. Your good intentions, I'm gonna pay the bill on time. If you don't have a good habit of paying your bills on time, you're not used to it. Why are you putting yourself with that kind of pressure?
Mm-hmm.
You need to put your bills on auto pay to make sure you got a good system for paying on time. Then you don't gotta have a good habit of remembering. Especially you got ADHD, we got poor working memory.
Yeah.
You working harder.
Mm-hmm.
Okay. That was good, friend. We about to close it up. Y'all have any questions in the chat? Y'all was in here chit chatting today. I appreciate y'all. Y'all chatting on both platforms. You said yes
I was
at the
thinking of
nail
nail
salon.
salon. Mm-hmm. And I
Mm-hmm.
was thinking about that when Coach B was talking about her building that trust in the relationships, right? So I thought the same thing when you're sitting in the chair at the nail salon, right?
Mm-hmm.
What you may go the first time, you did really good. Thank you. This is worth of me coming back. But after you done build that, let me tell you about my nail tech, okay? Now it seems like every time I go, my tip gets higher. Why? Because of the work that you do. I built that trust in you. I
Mm-hmm.
can now, you've made it more convenient for me because instead of me coming and telling you and showing you a picture, I've been here so many times, I just put my hands out and start talking.
You know what I want.
Here's my color, right? So now that's more convenient for me because of the relationship that we built. So that's the same thing that you're doing when you're getting this new card. I'm going to give you more when I trust you with more. You did a really good job this time, girl. Let's do it again.
Mm-hmm. Oh,
You
and
have
that's it right
to
there. That's a good point.
mm-hmm.
To celebrate yourself. I think like that's such a good point. It's like you don't even notice that you are doing a good job in some area.
Mm-hmm.
Like there's some area that you have worked on that you need to celebrate and say, bitch, you doing a good job, bitch. You doing a good job. Bitch, you doing a good job. You gotta give yourself some acknowledgement for the progress you made. I've
Mm-hmm.
had situations where my clients have had like a life event occur, and they've been working on savings, building up their pop-up buckets, and then a life event occurred, and then they got to use the money from savings to cover it. And that moment can feel a little discouraging because it felt good to look at the number and it's like,
Mm-hmm.
dang, my savings, right? And then I would ask them, I said, let me ask you a question. In the past, when this type of event occurred, how did you have to handle it in the past? And they're like, well, I probably had to borrow, either using my credit card or borrow from a family member. How did that make you feel? It made the situation with the family member uncomfortable. And even if
Mm-hmm.
they weren't making it, I felt uncomfortable, or I was really annoyed. I'm paying all of this credit card debt, still paying for it. Okay, which one of those feels worse? What this experiencing right now, or how you felt owing your sister?
Celebrate it.
Definitely owing them. I said, okay, so you've made progress, because in this time you didn't have to you'd have to go into debt to cover it, right?
Mm-hmm.
This time you were able to manage it. That's still progress. You're
Mm-hmm.
like, I wanted to be able to use this extra money to pay down this card, but you didn't add to the card. And
Yeah.
that's progress. And so we've got to be able to see like the small wins that we're making, maintaining, paying on time might be your very first step. You trying to worry about paying down. Let's just worry about paying consistently
Mm-hmm.
and celebrate that win. She said, I'm
Planning.
planning my first live to be a payoff party. Oh, can you invite us to your payoff party? We want to come. We love a payoff party, especially Coach T. She love a payoff party. Guys, if y'all not following her on TikTok, follow her. She's down here in this corner if you can't see, talking to us. Any other questions over here? Any other questions over here? Sure. She said sure. She gonna invite us. Okay, guys, that was good. I'm gonna wrap it up because we way over time. There's no way in hell we about to get leverage and credit in this conversation. We could barely get this into an hour that we supposed to do. Yeah, no, that wasn't a thing. That wasn't a thing. Y'all, if this was helpful to y'all, I really appreciate you guys. Follow Talisha. Talisha, can you please tell them where they can find you?
Yes. So on TikTok, it's Credit Rich T, and that's T with two E's. And for Instagram, it's T.Shanice. Of course, on Facebook, Talisha Chonece is my name. And I do have a legacy group, which is on Facebook. It's a Facebook community where I teach you how to build and repair your credit. And that's for free because we may not all be able to start with paying someone to do it. I give you the space to learn some of the steps to start the foundation. So definitely come join me.
Yes, thank you, thank you, thank you for coming out. For those of y'all, I forgot to introduce who the hell I am in the beginning of this. I'm ADHD Money Coach B. I talk about mental health as it relates to your money. I'm on a mission to help gifted Black women, overwhelmed women, anxious women, women who are overwhelmed by life, love themselves back to wealth. I'm here to help you shift from feeling financially frustrated to feeling financially unfuckwittable. If that is something you feel like you want to be, baby, I don't know why you're not following me already when the button is right over there, or wherever platform you are on. Follow me. Okay. Coach T is going to be back with us on Monday. We were supposed to wrap up today, but y'all asked for more and we giving you more because we love y'all like that. I told you from the heart. And so she is coming back on Monday at 5 o'clock. So you know how I feel. When you clock out of that man's dreams, where I want y'all to clock back into. Y'all tell me in the comments. Where are you clocking back into when you clock out of that man's dreams? Where? She said, I comment on all your posts and I appreciate you. Thank you so much. Thank you so much. I like you. That's right. Clock back into your dreams. That's right. Monday, 9 to 5 at 5 o'clock. Clock out that man's dreams and clock back into yours. I want to see y'all in the live. Until next time, y'all stay financially unfuckwittable and out of debt. Okay? That's it. That's all.
Whoop, whoop.